If we start with private equity, private equity is generally a more illiquid strategy. So typically investors in the private equity sector will invest for up to 10 years without expecting liquidity during that time. That's a very important distinction because if you're used to investing in the stock market, you're used to having a liquid investment that's equivalent to cash. That's not the case with private equity. Private equity are generally structured as limited partnerships with a very long life. So then when you delve further down into private equity, you have to look at the stages. So a typical private investor will look at anything from what's called venture capital, which is very early stage small companies, all the way up through the buyout phase, which is mergers and acquisition, and the very late life cycle stage of companies. So we fit in what's called the growth phase. So that's after a company has been venture funded or is a very early stage company, has moved through at least one, possibly two subsequent rounds of funding, has revenue, and oftentimes has profits. So they need exactly that growth stage. They need to move to the next stage of development. So if you look in the Silicon Valley, to take any of the companies you may have seen as examples, they've moved through those cycles themselves. Now our investment thesis is that a lot of that growth now is occurring in emerging markets, and specifically some of the markets that we focus on. For example, India and China. Developing economies where a lot of the sectors that we take for granted in this country are just now starting to grow. For example, the consumer sector, retail, infrastructure, so telephone, telecoms, financial services, so the availability of credit cards and banking services, they're all at an early growth phase and need growth capital. And so that's what we're providing in those areas.